to Jean, please, if you're still there.
I am still here, yes. Also with a mysterious black screen. And good to hear Richard's presentation just there. And good morning. Thanks to anyone who's logged in to hear what I have to say. Always appreciate there's so much content available now, and so many other things you might be doing. And so it's great to take your time. So if we move on to the next slide, please. Just wanted to give you a little look at who you're speaking to. So I'm Jean Roche, and I'm the lead fund manager of Schroder UK Midcap PLC, the investment trust. And that's the rest of the team there. Between us, over 90 years of investment experience, some of us with a bit more than others, but we've got Andy Bruff, who's pretty well known in this mid-cap arena in the UK, Ian Staples, and James Goodman. So hopefully you think a fine team of reliable people running, looking at all the ideas. And myself and Andy are both named on the fund. So if we move forward to the next slide. So, this is a UK mid-cap focused investment trust. It has around 50 holdings. So, that's a fairly concentrated fund. And as you might expect, the four people on that previous slide, we all love UK mid-caps. And this is just trying to capture the reason that we love UK mid-caps. And as you would expect, mainly it's because of the returns that are available. And we know it internally as the Heineken Index because it is refreshed like no other, if that's not obvious. And maybe that ad hasn't been around for a while now. And I think, what's very much front of mind at the moment, actually, with the news on Network International this morning and a fresh bid on that one, is that you get your returns enhanced because you get a lot of bids actually in this space and much more than you would in large cap. So the index is constantly refreshed, not only by companies being bought and new ones coming in, but you also have companies, I would refer to them as fallen angels, coming out of the FTSE 100 and at interesting valuation points into the mid 250 index. And of course, that's the index, the next 250 companies below the FTSE 100 in terms of market cap, excluding investment trusts. You also have companies promoted from the small cap, and you have IPOs as well. And so, it's a very sort of interesting collection of 170 or so companies. You've got a wealth of companies in very high growth niches. We have around 89 different investment themes, we estimate, across 170 different companies. So you're able to pick out all kinds of smaller themes, and they can be, they can be working outside of the bigger economic and whatever the macro theme of the day might be. You get these small growth areas. It could be anything from cybersecurity to luxury watches or strategic board games. You've got dividend payouts, which tend to be very well covered in this part of the market at the moment, 3 times covered. And for this fund, what we like about it is, and this strategy, you have a clear sell signal when a company is promoted to the FTSE 100, because we feel that you see the best of the growth from a company in terms of its share price as it moves through through this part of the market. So we wave companies off when they move into the FTSE 100 with a packed lunch and wish them well, and then we're ready to meet them if they come back down into the mid 250 again. And you get, you have a very different sector exposure here to the FTSE 100. If you just look at the UK market, 10 companies are responsible for 50% of the market cap of the UK. So, we are, we're very interested in the companies outside of that. Talking about why this is such a great index, I think what surprises people is that it's actually outperformed most other major developed market indices over the last 25 years, including the S&P 500, or at least has been neck and neck with it. And I think that does surprise people on a total return basis. And just to remind you, these are 6 of the reasons we pull out as to how it maybe has done that. And the final part I wanted to talk about was just, far from being just a UK index, half of the revenues from the companies in this index come from outside the UK. So I'm not saying whether inside or outside the UK is better, but just that you have a very good menu of companies and exposures inside and outside the UK in this index, although it would be commonly seen as a very domestic index. It's about 50% of revenues. So if we move forward, what kinds of companies can you expect to see in our fund? of around 55 holdings. Moving to slide 3. So what are we looking for? We're looking for companies that could be the future FTSE 100 companies, companies that we think can move into that index. And so we sometimes call this the slide of doom, because as soon as you put a few companies on a slide like this, something unexpected happens. But here goes. So Games Workshop, I'm sure a lot of you will have heard of the Warhammer game, and maybe even will have played it in the past. And certainly my 2 sons are looking into it, are eyeing it up at the age they're getting to now, close to double digits. So in terms of years, but with there we see a huge US opportunity, and news of their potential tie-up with Amazon to make content, possibly driving that hobby further, and meaning that, you know, although it's a well-known hobby here, playing strategic board games with small, with miniature plastic pieces and a measuring tape and some dice, that, you know, something that can really grow to become even more of an international story than it already is. And very high margins there on that one. Man Group, a fund manager which is ahead of the game in terms of its use of technology. Telecom Plus, you may have seen their utility warehouse billboards at a train station near you, and they're offering very competitive multi-utility services which simplify the job that probably most of us hate, which is looking at various utility bills across the household. So look out for those billboards, and that one we also think has huge growth potential. And then Spectris, which does advanced scientific instruments, which save companies money by speeding up what they do, and checking what they do as well. And they're exposed to pharma, auto, and the aerospace industry, as well as, you know, more general industrial. So there are, you know, 4 names that we think could be FTSE 100 companies of the future. And as you'd expect, we hold them in the fund. If we move forward to the next slide, please. And we thought it might be interesting for you to see, you know, the fund is actually focused, has a very much a capital growth focus, but as it turns out, the strategy that we run does actually deliver good dividends as well. And if you're looking for multi-baggers, and I'm sure most of us are, you could see that the dividend here has actually grown by nearly 10 times over the last 20 years. And if you compare that with what house prices have done, for example, they've only doubled during that period. Milk has only doubled as well, the cost of a pint of milk. Beer has done slightly better, up 2.6 times in that time period. But I think it's quite interesting to compare those things. And, you know, this dividend has grown through some pretty hairy times, through the global financial crisis, the Brexit vote, the pandemic, and more recently, the sad events in Ukraine. So, you know, I think you could see that as a very resilient and a very resilient dividend, and, you know, very, I think, remarkable that it can carry on growing despite the rhetoric around UK markets and why you might not want to be a listed company here. These companies are managing to pay good dividends, running very strong businesses and growing their earnings, and then able to pay well-covered dividends out of that. I mentioned earlier how well those dividends are covered. So we move on to the next slide. This is just showing, you can refer to this later. I mentioned that the FTSE 100 was very concentrated in certain sectors, and that, you know, the top 10 companies actually are responsible for 50% of the market cap of the whole market. So by definition, there's a lot more interesting niches below those very large companies, which are focused in areas such as mining, energy, and banks, and also pharmaceuticals. You get just a much more interesting range of niches when you move down into the FTSE 250, and even within the industrials, you get some very interesting companies below that. Electronic engineers, which are very good in this country, for example. If you move to the next page, please. And I talked about bids earlier. I call this the Blackadder slide, actually, because of the font that's ended up on there. But what I was saying, and I pulled this together actually late last year, is that by definition, mid caps are much more likely to be acquired than large caps, because they're far more digestible size, and that helps to, so, you know, the premia you get when a company is taken out. I mean, last year some of the premia were up close to 100%. This year to date is more like 40-50%, but that enhances the returns in the fund. And actually, I thought in the Blackadder handwriting there, actually, that there was some pent-up demand coming through at the end of last year, that there must be some sort of appetite coming up at the start of this year. And lo and behold, we've seen 4 bids in the last week for UK small and mid caps. And some, you know, quite large mid caps, actually. Dechra, an animal pharmaceuticals company, Network International, We've also had year-to-date Dignity, we've had John Wood more recently, and the proud owners of the Franco Manca brand also being bid for. Fulham Shore, that company is. So I think you are seeing, and it's interesting, it's PE as well that's bidding this year, whereas it was strategic money last year. For example, the acquisition of Brewin Dolphin by RBC. But this year it's, and very much in the last week, it's been PE deciding that actually that valuation is looking very attractive now. And I would tend to agree with them. So if we move forward, I mentioned that you can make very good money in UK stock, but it's not all about takeouts, generating those returns. And actually, my colleague and I, James Goodman, were really interested to see that the UK beats the US in terms of the number of multi-baggers created, in terms of the potential for to find a UK company that's a multi-bagger is better in the UK than it is in the US, because of all the stocks we analysed across the UK and the US markets. We looked at the number of stocks you could actually invest in, with so certain minimum market capitalization, and then the number that returned 30 times or more in the 30 years to the end of December 2022. And we found that you'd a better chance of getting one of those in the UK than you did in the US, which might be surprising to many commentators who are saying that that you want to be moving out of the UK and into the US, and indeed much of the money that's moved abroad from an investment point of view and out of the UK. But we actually we did this work for the LSE on the 30th anniversary of the FTSE 250 index late last year. And obviously it's Peter Lynch who coined the phrase multi-bagger to begin with. But we thought, how many companies have returned 30 times over the 30 years of the existence of the FTSE 250 index, which has been such a strong index. And actually it's quite a high number of them. And if we move forward to the next page, we can see that actually a lot of those companies are pretty well known, well loved UK mid caps. Cranswick, the maker of the McDonald's crispy burger, which maybe some of you are fans of, and I think it has its own Instagram account, that particular burger, and plenty of influencers following it. But you also have Clarkson's, the most successful global shipping services company. You also have Grainger, which is a private rented sector landlord, and HomeServe, who are insuring the piece of pipe outside your house in the driveway to make sure that if it bursts, somebody else can pay for it. All the way to Savills, which you'll know from its real estate roots and stores in the high street, as well as being an advisor globally to real estate people involved in the real estate industry. So all of these actually on this slide, this is just a selection of those 60 plus 30 baggers that we found in the UK market over that time period, and all of these names have been owned by this trust and in this strategy at one stage or another, or some of them are actually owned by the fund right now. So if we move forward to the next slide, I mentioned to you earlier, that yellow line there, that's the mid 250 index, and that's showing you that it has beaten the S&P 500, which is just below it, over the last 25 years. Now that was taken to the 20th of March, and that's in local currency, but if you do it in dollars as well, in February, the two indices are neck and neck. And actually the point really is that the S&P and the mid 250 are neck and neck in terms of returns over the long term, leaving many of the other developed markets for dust. And this trust has beaten that index, the yellow and the dark blue line there. If we move forward, another slide is just showing you some of the performance statistics over the last year, 3 years, 5 years, 10 years, and you've got a discount of, when I checked it yesterday, it was 14% to NAV, and the opening section of this show talked about some discounts to NAV, and so I think the audience is probably familiar with that. So you get the UK discount. The UK is inexpensive, and it's not just, you might say mid caps are generally expensive, and it's the FTSE 100 that's cheap, but actually UK mid caps at this point in time are inexpensive, and I have some data to show that in a minute. And then you get a discount to that with the investment trust. And you can see those headlines on the right. In any one day, you can find plenty of press negativity. Although I will note that the consumer confidence data from the GfK today is showing a high, relative 14-month high in consumer confidence across all aspects, including large purchases, consumers feeling a bit better about life, and that might be linked to the 10% increase in income that 20 million people have seen in April in this country, with universal credit, with the triple lock kicking in. And it's been actually a big boost to consumers in April, which we would expect to see coming through. So there's the performance of the trust relative to that very strong underlying index. So we move forward. That is just a compliance required slide. If we move forward to the next one. Yeah, I talked to you about a little bit about valuation, and that premium of mid caps has moved right back. That's the green line there on the right. And then you might say, well, hasn't the earnings season been dreadful? But actually, we've now got more upgrades than downgrades on a sort of a 1 month basis, looking back, and the 3 month ratio is quite neutral now. So earnings revisions for the companies, and lots of them have even yesterday we had Reading Northgate upgrading or the day before yesterday for the full year ahead at Q1 stage. So I think you're seeing a lot of confidence from some of these UK corporates after what might have felt like some dark days, and the valuations, as I said, looking quite attractive. So no surprise that PE is dusting down their files and starting to move forward. And the other bit I forgot to mention actually when I was talking about it, that's come out in the last week, was the HUD Group, of course. If we move forward to the next slide, then just looking at that sort of lime green line, second from the bottom, that's mid caps there, sitting at a huge discount on a global scale to most other markets. So again, a very attractive point in time in terms of valuations, and that's just on PE ratios for this year. But it's it's retrenched and looking attractive, I think, to many. And I don't show it here, but the dividend yield also on the opportunity set is in excess of 3.5% too. So on relative to what has been in the past, relative to FTSE 100 and globals, at an attractive place also, if you're looking at equities. So moving forward from here, so how do we do it and what do we do? Well, we categorize our universe into 3 different types of stocks: what we call unique stocks, then flex stocks, and stocks to avoid. And hopefully the third category is self-explanatory, but I'll give you a little bit more feel for that in a minute. But what are we looking for with these unique stocks? Well, some of those stocks I said might be able to grow to be FTSE 100 stocks of the future. They would fit into that unique stocks camp. They might have like a scarcity value, a very strong business franchise. What they do, you can't get access to that anywhere else. You can't really get access to the Warhammer portfolio or access to that growth niche by investing in any other company. They will have quality management, as you'd expect. They're able to generate above average returns on their capital employed, which is what you want to see as a shareholder. Usually they'll have strong balance sheets, and they might be a little bit more expensive than the next category I was going to talk about, which is the flex stocks. But we would look at that on a PEG basis usually, if we can, which is price earnings divided by 3 years growth, to check, what are you paying for that actual growth? So, these are companies that you can't get access to by investing in anything else in our investment universe. So they're the unique stocks. So we decide whether stocks are unique. Maybe if they're not unique, are they flex stocks? So flex stocks are in industries which are undergoing quite a bit of change. There could be capacity coming in and out of that industry. There could be lots of share buybacks going on in that sector of the market. It could be a cyclical company. Often it's a company which is at a strategic crossroads. There might be a change of management. For example, a new CEO. And the valuation will generally be reflective of that. So you'd expect a lower PE or PEG, or we look at EV/EBITDA as you'd expect, at free cash flow yield, all those things. But the valuation you would expect would be a little more just lower than a unique stock, for example. And what I would say about unique stocks as well is those ones are stocks where probably the company is more likely to be acquired, because for that very reason of it being unique and exposed to a certain niche, then it's far more interesting for a potential acquirer. And then stocks to avoid, well, what are they? Well, usually they are shares in companies where management have been destroying value. So unsurprisingly, we want to avoid those. They'll tend to have poor returns on capital, maybe will have done some poor deals, there'll be often overcapacity in the industry, where supply is exceeding demand for the product potentially. And so for us, they'll be ones to avoid. And if they also have the added negative of significant accounting concerns, that will be also a reason to avoid. So I think that's probably quite clear. And so what we do is, when we've decided what are unique and what are flex stocks, then we'll take the most attractively priced unique and flex stocks and put them together in our portfolio. And we like to have about 40 to 60% unique names if we can. And at the moment, the portfolio has 40% weighting in unique names, because some, stocks, while they might be unique, we might not want to own them because they're too expensive. So if we move forward to the next slide. So I've told you how we like to buy, but I have a little post-it note next to my desk as well, which says, "Don't forget to sell." That was handed to me on the first day I joined Schroder, 7 years, a bit more than 7 years ago now. So, as you'd expect, we have a selling discipline. And as our favorite reason that we are selling a stock is when it's going to the FTSE 100, so we can reinvest into a better opportunity, because many times the best returns come from stocks in the bottom 2 quartiles of our investment universe. But other reasons to sell might be frequent or expensive acquisitions, especially if lots of shares are being issued to do that. It might be just that the investment thesis has played out. We see an issue in the quality of the accounting of the company. If you see, and there actually it's frequent exceptionals, large exceptionals, or several years in a row of exceptionals, that would be an alarm bell for us. If they're failing to respond to disruption, if there are big changes in their industry, but they're not responding to that, not changing what they're doing to respond to that. I talked about valuation. When companies are acquired, we'll also sell. If we see a change in the sustainability behavior or in the management's behavior around ESG, we could also sell. And if we see lots of competition coming into the industry. So as you'd expect, a lot of this, if you were drawing a Venn diagram, a lot of this crosses over with the stocks to avoid side of things as well, and that category. But these are 9 reasons to sell, and we find that we have a lot of incoming on reasons to buy, but not many reasons to sell. So it's good to have this, what looks a bit like a dartboard actually, but isn't, reminding us of reasons that we would want to be selling. So plenty of reasons to be doing that. So if we move on to the next slide, an example of a unique stock, I thought that'd be useful for you. So that chap on the right, he might look a bit familiar to any of you who are fans of the Warhammer game. But just a bit more background on what we might expect from this kind of company. And what I might just pick out is that sales growth of 20% compound since 2015, since the new CEO joined the business. But as you'd expect, many reasons to pull out the quality of this one. And still looking at potential significant growth in the US. So we move forward one more. I talked about the long-term trend of outperformance, and this is since launch, which is 2003 on the far right. But moving back to the more recent 3-month period as well. But we are long-term investors, a holding period 4 or 5 years typically. But if an investment case plays out sooner than that, then we can move on and reinvest in something else. This is the best performing UK equity investment trust since launch in its sector in 2003. And I've mentioned I've been involved for the last 7 years. So I can't take all that credit. But Andy Bruff was there from the beginning, and he's still the co-manager on the fund. So if we move forward from here, and the strategy is the same as it was then too. Just on my conclusion, hopefully you've gathered that this is a very tough index to beat actually, but we've managed to do that. And I think this huge negativity towards the UK markets is just an opportunity, because we're still, we were at a site visit to see a company yesterday, and it's still very much, it's really inspiring to see management teams growing top lines, investing. We saw actually the CFO, the finance director's survey on Monday, which Deloitte carries out, showed them, being really positive. And, there are industry leaders who are growing companies and seeing opportunities and managing to grow their earnings, and then paying out good dividends, reinvesting their capital, and creating things like the McCrispy burger for us all. And, we really do have world-class businesses in this country. So we're looking for companies that can grow. They have sustainable business models. They are resilient. They'll have good balance sheets. and they see opportunities. And so we feel that our holdings position us very well for what happens next. And we do have a website for the trust, as you'd expect. So I'm sure we can share that with you afterwards if there's any demand for it. And if we move to the last slide, it's just, you know, some more statistics on the fund itself, because that's probably useful for you to refer to. Thank you very much for listening.